So I just hit the recording, so I'll introduce myself for those of you that don't know me. I'm Katie Swanson, and I'm the founder of Auxin Labs. I just started this community to help people break into investing and help current investors potentially get LPs, share deal flow, and be an educational space to support one another. Cheryl needs very little introduction, but she is a serial entrepreneur, and I'll pass things on to her. I am happy to answer questions in the Q&A period as well, if Cheryl wants me to hop in at all. So there you go.
Perfect. Yeah, I'm actually trying to open my chat window and everything is going slow in my world today. I'd love a show of hands or voices in chat just to get started. Who in here has written at least one angel check? I can't see chat for some reason. Oh, here we go. Okay, how many people haven't written an angel check yet, but would really like to? All right. Sweet, sweet. Oh, this is all the goodness I want to hear. Cool. So then we're going to do a gauge at the end about sort of where people are confidence-wise about running to write checks, because we have people that haven't written a check yet. And I'll give you a secret. That first check is such a stinking rush. It's unbelievable. Because you're helping a founder make something amazing, amazing happen. Great. Oh, I love that I got chat working. I don't know why my slides are foggy. They're not actually important to what I'm saying. They're just putting something there so it's not my face all the time. So just assume it's your eyes and get new glasses, I think is the best plan here. Awesome. So the topic today is angel on any budget. And I'm stretching that definition a little bit to talk about how I got over the hump and started writing angel checks. Because what I've seen over the past few years is the journey I've gone through is actually what a lot of people are going through in their heads right now before they write that first check. As a little bit of background, I am a 2-time founder, a 3-time Ironman, and a 4-time mom. And that's actually a little bit of a lie because I'm starting up again. But over the past 12 years, I've been a venture-backed founder twice. My first company was consumer electronics, and we funded it with a mix of Kickstarter crowdfunding and VC. My second company was a healthcare fintech. I raised close to 20 million in VC, grew that company to 10 million in ARR before selling it about 2.5 years ago. Some people were very happy with that sale and did very well with it. I was not one of those people. So I didn't leave that all with a boatload of money. But I've spent the last year sort of figuring out, or maybe because I didn't leave with a boatload of money, I've spent the last year figuring out what my next startup is. And while doing that, I am an EIR at Techstars pre-accelerator program. So pretty much I have 30 first-time, really early stage founders running through my program 3 or 4 times a year. I've worked with nearly 200 founders over the past 2 years. So I've seen a lot of things. I am also, I think the most important thing to know about me is that I'm a giant Gen Xer and a huge Deion Sanders fan. So every presentation I do, you get a little dose of Deion there. And I made this special Deion for you all because he's going to make me happy because he's on my screen. So when I sold my company 2.5 years ago, so about 2 years ago, I decided I wanted to learn how to angel invest. And again, it wasn't because I made so much money on my startup that I had a big wad of cash burning a hole in my pocket. I wanted to learn to angel invest because I wanted to be able to think like an investor. I figured it would help me be a better founder. It would help me be a better mentor to my startups. But I really didn't think I would write checks at all. I didn't think I had the knowledge to do it. And I didn't think I had the cash to do it. But then I started seeing more startup pitches, and it became really clear to me that I had to get in the game because first check calls game. That first check decides what problems get solved and who gets to solve them. And I noticed in these groups, I was seeing things and gravitating towards founders and companies that maybe all my peers wouldn't. I was seeing different things than they were seeing. And particularly, you know, rich cis white men don't have a monopoly on the problems. They are writing the most checks now. So the more of us that enter in the check writing game with different backgrounds and different experiences, the more it's got to happen. We've got to get in the game to get our kinds of problems solved. So I had this great desire to get in the game. Fast forward 18 months later, and I am sitting on a portfolio that looks like this. I have made 15 individual angel investments. I'm loud and proud about I write baby checks. My checks are between $1,000 and $2,000. That's what I focus on. I write baby checks. There's a few bigger circles in there, which is the times I broke my rule and wrote bigger checks than that. Um, and then recently I stepped in and I wrote a micro LP check. I had seen an early stage fund in action. I was part of their angel group. I loved the GP on the fund, and she let me write a $15,000 check into the fund, and she's going to be investing across 30 companies. So loud and proud baby checks here. Have built this portfolio and not stopping anytime soon. But it took me about 9 months to write that first check, because the two things I had to get over was the hump of I don't have the knowledge, and the second hump was I don't have the money. And those are the two parts of my journey, and that's what we're gonna talk through today. Now, it's actually not surprising that I felt that way, and I suspect if we did a show of hands again, there's probably a bunch of people in the room that sort of feel they fall into one of those camps. You don't know enough, or maybe you don't have enough money. And it's easy to think that because the story we're told about angel makes it look like we should be investing like VCs, right? 2 or 3 really high conviction bets a year for, $20,000, $30,000, $50,000. Maybe these are bets we double down on over time. Has to be about industries we deeply understand. And, I hear all the time, I've got to be able to add value to those startups. Having been a longtime founder, I have a little bit of opinion about that and who can really add value, but I'm going to keep that to myself. The TLDR for me is when I first started looking at this, I thought those were the rules, and it felt really intimidating and really expensive. What I have learned over the last 2 years is that it's also really wrong and frankly, a little bit dangerous. Because here's the deal. Angels are not small VCs. VCs have a job to do. They are deploying other people's capital. If their returns are not in the top quartile and even probably the top 5 or 10% of all returns, they won't get the chance to raise another fund. So their job is to make a few small bets and go super hard on those bets to help those companies succeed, to get more money in their bet, to do the thing of like returning the fund. So make sure there's a giant exit, not just in terms of multiple, but giant exit in terms of absolute capital. That is their job. As angels, our job's a little bit different. We need to beat the public markets for sure. But we also, most angels that don't want to go on to be VCs also want some downside protection. What happens when you're, a VC, you need to be that top 5 percentile. So you rather make a few bets and hope they're really, really right. But here's what happens. If you look at, on average over a group of 20 startups and how they exit out over time, about 75% of those companies, 14, 15, they're going to either go to zero or return exactly the money you invested. So 0 to 1x returns. Most of what you invest in will look like duds. This is early stage startups, right? There's a failure rate. About 25% will return to 5 to 10x of your money, right? They need to cover themselves. They need to cover the ones that failed and then make some profit on top of it. And then maybe in every 20 bets, you'll get a home run that looks anywhere from a 25x to a 1,000x exit. You'll get a big one in there. So if you are making less than 20 bets, you have a chance to do really, really well because one of your 5 bets a year might be one of those home runs. But it also might be 75% of those duds. And those are the kind of returns you see in VC investing. There's a whole bunch that do really well, and there's a bunch, like 30%, that go to zero, do worse than public markets, or actually lose money. If you're an angel, you actually want to sort of participate in all of that because it averages out better, but you're not likely to sort of, be at the top of that stack, right? As an angel, our job is to beat public markets on a financial basis, to make it worth the risk, make it worth the lockup time, but we don't have to be the very, very best. And if we can give ourselves some downside cushion or downside protection, that's amazing. One thing that really struck me before I got into angels, I would hear everyone say, but be prepared to lose all your money. And I was like, wait a minute, y'all think you're so smart. You're doing angel. I see a whole bunch of people making a ton of money off of it, but you're telling me I should expect to lose all my money. Makes zero sense. So this is where I started to dig in this research, and I love math. So I dug in pretty deep. And what really got me over the hump on angel investing was a set of research that this guy, Abe Othman, who is the chief data science at AngelList, did. He did this research right before the pandemic. It sort of got buried in the pandemic. Not many people have seen it, but it was super, super interesting. He looked at all the companies that have passed through AngelList over the last decade, and there's been thousands of them. They see every company that takes venture funding. And the TLDR in this math was portfolio size matters more than company picking. In fact, it didn't just matter more than company picking, it was all that mattered. They looked at all of their data, and the clearest indicator of success from the point of view of an angel, beating public markets, being really consistent, was not the companies picked, but the size of the portfolio. Because of that chart I showed you before, in early stage investing, if you just make a few bets, what you are really buying is lottery tickets. Maybe you'll get that one really great one and not a lot of duds, and you do super well, but you could also end up with a handful of nothing. If you look at the math and look at the modeling, as you increase the number of bets you're making, something like the super magic thing happens. At a certain point, your portfolio is big enough, and those lottery tickets, because you've got so many, the variability compresses and they flip. And instead of looking like lottery tickets, they start to perform like a more predictable, high-performing asset class. It's super cool. It's like lottery ticket, and then boom, you get a really predictable, more narrow range of returns, but more predictable, and it beats public markets. And do you know what that magic number is? It's not 1,000, it's not 500, it's 30. At about 30 investments, the nature of angel investing changes, and it starts to look more predictable. I'm going to share some resources at the end. Oh yeah, that is the research I'm talking about. I'm going to share a QR code at the end. We've got this posted on our website because it's super geeky and it's super awesome. Here's a little graph that sort of shows you 30 is the magic number. This was the most empowering information I saw as an early angel, because what it was really saying is I didn't have to wring my hands about the deals I was picking. As long as they were credible deals, like they could actually grow big, they were actually solving a real problem. It didn't matter which ones I picked. It mattered how many bets I made. And I was stoked. I was like, this is amazing. I just have to make enough bets. And I had this newfound confidence coming out of this research. And it really occurred to me, like, angel investing is a game of outliers, right? one out of those 20 companies may make it big. What is that outlier? Well, if we're looking for outliers, maybe each of us are already better angels than we know, right? Each individual startup only has a few data points. There is only so much diligence you can do on an early stage company, right? They don't have a lot of financial returns. They're actually still figuring out their market. Being a founder for 12 years, I know that there are a million things that will change on that startup journey. You pivot problems, you pivot solutions, you pivot customer bases. It's truly a mix of picking a problem space that's big enough to maneuver in, and then like just putting your heads down and running at it with a kind of resilience and a whole lot of luck. And I can talk to the fact that it is a whole lot of luck because I'm actually a really good entrepreneur, and I grew a business really fast, and I sold that business, and I don't have a big truck full of money. So there's a whole lot of luck involved too. So we are actually already better angels than we know, because you know what? Even though an early stage startup doesn't have a lot of data points on it, do you know what has a million data points on it? It's each of our guts, right? We feel before we think, because that feeling actually is a lifetime worth of data. It's the data points of our lived experience that helps us understand what problems are out there that need to be solved, and helps us understand like the opportunities solving those different problems would provide. And those data points help us get a really great read on people. And in early stage investing, I mean, the most experienced early stage investors will tell you it's all about the team. We each have developed a gut over our whole lives that gives us a read on, is this a great team? Do they feel like they're resilient enough and clever enough and like driven enough to figure this early stage thing out? So to me, this was very empowering because it gave me the permission, if I made enough bets, to trust my gut and develop that gut and my instinct as I was actually writing checks. I didn't need to sit on the sidelines and wait for this big aha epiphany of I knew something. I could make tiny checks and tiny bets as I went. Once I figured out the money equation, that's what I jumped into. So for me now, when I look at a startup, I just really think about two things. If everything goes right, can this be a business that 25x's or 10x's or 50x's, or just grows, exponentially, and that I wake up and am excited to be a part of? Both those things have to be true. And I have made those 15 investments. There are some founders I wake up and think about every morning because I'm so excited to be a part of it. And I do think they're sitting on businesses that could grow at least 25x of what I invested in them at. The second question I ask, when everything goes wrong, right? If everything goes right, but when everything goes wrong, because my lived experience says everything will somehow go wrong, is that founder resilient enough to figure it out? Do I believe them? Do I trust them? Do they love this problem enough that they're going to keep battling through to find the answer every day? Both of those things I can trust my gut with. I will say my gut is, I can't gauge if it's getting better, right? There's a long tail on angel investments playing out, but I'm adding new knowledge on business models and markets to that gut every day, but I'm adding it by doing and writing those checks. And that's been a massive, massive unlock to me. Sounds like it's too good to be true, but truly the math backs it up. The number of bets, not the actual companies you're betting on, as long as you're betting on credible things that can scale. I can say all that, but making 10 to 15 investments a year for at least 3 to 5 years without thinking twice about where that money is going to come from, maybe is the harder part. That's a lot of bets and a lot of money. And you've got to do that to get portfolio diversity, and you've got to do that to get diversity over market cycles. Like, it would sort of suck if you made your 10 to 15 or 30 angel investments all at the frothiest time of the market. You want to do that over time. And most of us don't show up with a big fat pile of money to do it. So for me, once I got over the hump of understanding the portfolio math and what I really needed to know to start making these, to me, small bets, on these companies, the next thing I had to do was set my budget and find my budget. I want to talk about that, but I want to break here for a second. Questions. I went through a lot of sort of big thoughts backed with data that I waved my hands around about a little bit. But are there any questions on that concept of, as an angel, your job is maybe to build a portfolio, and that's more important than picking?
And feel free to just unmute yourself and speak up, raise your hand, whatever you're
Yeah.
most comfortable with.
I didn't see any questions come in on the chat, but I have to imagine there's some. No. Is it making sense? Does that notion, like, in something based on outliers, it's about shots on goal?
Yeah, I for that was really helpful. And I give you an unfair advantage of being that founder at one time. Because
yes, that's true. It is an unfair advantage.
I think your gut is tuned more than you realize. But that whole idea and the portfolio approach and the time it takes, that makes a lot of sense, at least to me.
I do admit I do have an unfair advantage in building confidence in that. I know what kind of founder things I like, and I see it right away. That's where the math, though, was super compelling to me, because they just did randomized portfolios, and it didn't matter what companies were in it. It produced the same results every time. Cool. Thank you for asking that, John, and saying that. All right, since I don't see any more questions, let's talk a little bit about setting your angel budget. So this was the next big piece for me. So I'm going to caveat, this is not financial advice, but it is the kind of advice your mom would give you. So before you think about angel investing, make sure you've paid off all your super high interest. Build an FU fund for a rainy day and contribute enough money to your company 401k match, because they're giving you free money. After you do those things, then it's time, to think about investing. And the thing about investing, the new common knowledge out there from financial advisors sort of all over the place, is alternative investments. Things that are not publicly traded stocks and bonds should actually be about 15 to 25% of your total portfolio. Angel investing falls in that bunch. There's no hard and fast guidelines of how much or little should be. That's, each person's personal preference. There is knowledge that angel investing is not correlated with public markets like you actually think it is. So it does function as an alternative investment. Some folks say between 5 and 10% of your alternative investments can be in angel investing. Because I'm close to the startup space, I have 10%. I think if I was farther away from the startup space and wasn't a founder myself, it would probably be closer to 5%. But that frees up a lot of money in your mind if you think about all of your assets. This is not the money coming in on your paycheck every week, but it's all of your assets, your retirement funds, your outside inheritances, whatever that money is. 15 to 25% should be in alternative assets, and maybe 5 to 10% is a decent amount, a healthy amount, a not dangerous amount to have in startups. For me, though, I put another layer on top of it, because what I've seen over the past 2 years is that the ROI of angel investing goes well beyond just financial returns. So when I was setting my angel budget, I looked at the right percent of my assets, and then I said, what other parts of my budget am I going to put in here? Angel investing for me is a big part of my professional development. It's a big part of my social circles. It's a big part of professional networking. And honestly, maybe I shouldn't say this, but also some days it's a little bit like shopping. This is what I talk to my girlfriends about. Not this cute new purse, but did you see that startup I just invested in? So I've expanded my budget beyond that 5 or 10% because I've taken part of my personal professional development budget. I have taken part of my shoe budget. I have taken part of my social budget and allocated it towards Angel because Angel is filling a lot of those needs for me. But I still needed to find the money. I can say I have this budget, but where is that money? For me, I realized it was hiding in plain sight. It was sitting in my IRA. Not many people know you can do this, and it's a relatively new thing, but retirement savings can be a great source of capital because that capital has the characteristics of angel investing, right? That money sitting in your IRA, it's absolutely untouchable. So if you need to make 10 to 15 investments a year, every year for 3 to 5 years, and you can't be thinking of, do I make that angel bet or do I remodel the bathroom? Do I invest in that company or do I spend a weekend in Tulum in February? You can't be having those trade-offs in your head. It's too hard to manage. The money sitting in your IRA, that's untouchable. You're not getting it till you die anyways. It's evergreen. If you're an accredited investor, you're probably contributing to it every year. And let's be really clear, it's bringing you no joy, right? Think about the job you had 5 years ago and you've got some money sitting in a rollover IRA from that. Is that getting you excited sitting in an ETF? Mm-mm. Angel investing? It can start giving you other non-ROI benefits if you enable it for that. This has gotten really easy over the last, I would say probably the last year, 9 months to a year. There's 2 companies. One is called Alto IRA. The other is called Carry that let you either contribute new dollars or roll over existing dollars into a retirement account that lets you invest in startups. You get choices that aren't just stocks and bonds. You can invest in stuff in AngelList. You can invest in stuff on Sidecar. You can invest in startups directly. Super exciting. They are both the easiest services in the world to use. I use both of them. If you think this is where you're going to find your budget for angel investing, I totally encourage you to check either one of them out. And then maybe think of it like this. Like folks that are younger, that maybe don't have rollover IRAs from a big, long 30-year career, your best bet might say, hey, make a few extra Roth contributions and use that for angel investing. Roth contributions are great because you pay the taxes up front, but then you don't pay taxes on your gains down the road. The money is locked up till your retirement age, but completely not taxed, and it can keep compounding in those accounts. If you've been around a little longer like me or John, I see you. You've probably sitting around with a bunch of small rollover IRAs, maybe 20,000 here, 15,000 there. I had one with $40,000 in it. This is an amazing way to get started because it feels like found money. And it's just really easy to get going, to dip your feet in and write the first check or the second check and see if you like it, see if you find your people, see if you find it exciting. And it's a pretty low risk way to do it. So that's how I got over the hump of knowledge, and I got over the hump of where was that money and did I have the budget? I don't know if that's resonating with folks. I hate when it gets quiet. I'm like, But I think we are all better angels than we already know if we understand a little portfolio math. We all probably have budgets we didn't realize we had because they're hiding away in a retirement plan somewhere, perhaps. I will say there was a third problem I encountered, and it's 15 investments a year is really, really hard to make. I have to see between 20 and 40 deals before I see something that like makes my heart beat a little stronger. And I'm talking about, deals that are well vetted, ones that have a check from a initial pre-seed or seed stage check from a new emerging fund manager, or ones that have been vetted by a high velocity, angel group. Even among those, the ones that really make my heart beat, I'll have to see 20 to 40, which is to write 15 checks, super exhausting. It actually sort of starts to get not fun. This is the piece. This is where I'm a founder at heart, right? I told you I started angel investing so I could be a better founder. It led me to my next startup, which is how Katie and I met. My new startup, Play Money, makes it easy and fun to see enough highly vetted and targeted deals a year that you can easily gamify and get yourself to 15 investments a year, and to be able to do it with friends and to meet new people along the way. So I had 3 problems. I had the math work me through the I don't have enough knowledge. I had the magic unlock of my IRA and a little guru math of how I'm putting my shoe budget towards angel investing, get me through the I don't have the money. And then I'm building a company to get me through the 15 investments is hard. And there we have it. I would love a little Q&A. And if you don't ask me questions, I want to go around and just understand how people are thinking different now, or how they're feeling about writing a first check, or where they're looking for opportunities. And this QR code here will bring you to a page on my website with all my favorite geeky reading and research, where all these numbers came from. If you want to tool around like me, like a dork.
Well, to kick things off, I want to say thank you so much, Cheryl. And I do encourage everyone to ask questions. I posted in the chat that I'll be sending a follow-up email with links to Alta, Carrie, and Let's Play Money, my company as well, and anything that I may have missed. But I really, really want to highlight, I know there's a lot of people here that have reached out to me previously and said, how do I invest when I don't want to write checks that are the standard, 100K, 200K that I'm typically seeing, right? And that's why I wanted to bring Cheryl on, because you don't need to do that. You can invest 1K, 5K, whatever your budget is, you can become an angel investor, and you can utilize this space that is, feels inaccessible to a lot of people. So hopefully that triggers some questions. And we do have one in the chat. Lily, you're welcome to speak up. Or I'm happy to read the question out loud.
What are the potential negatives to putting 1K into 40 deals in year 1 of an angel program? That is a great question. You want to make sure that you can invest across market cycles. Like 2020, 2021 was super frothy. Companies were raising a ton of money at really high valuations. If you dropped your 40 investments into that market cycle, you would probably have invested in companies that were a disproportionate number were overvalued and might have trouble raising in the future. You might have invested in a disproportional number that were like in the trendy industry of Web3. You're going to have a level of lack of diversity. What am I saying? Concentration in maybe industries and in market cycles that you probably don't want. So that diversity is not just a number of companies, but in market cycles and industries over time. So if you did 40 companies in that 1 year, you would probably be well served to do 40 companies the next year. So there's a method to the madness about evenness and really getting the full range of the diversity. Yes, very similar to dollar cost averaging in a mutual fund, so to speak. I've found as I go too, I love having investments that I can still make in my pocket, because I'll get geeky on a little industry, or I'll, learn something new and want to go down a rabbit hole, or I'm seeing a different kind of founder that I really like. I did little like a fun journey down real estate fintechs at the end of the summer. I liked the space, and I dug into it a little bit, and I was glad I had the chance to do it and had some investments to make for the year so I could follow that pursuit and that learning. I like spreading them out too because I invest with friends. I'm a part of a few angel groups, sort of like what Katie's building here. And I want to be able to show up on a weekly basis or a monthly basis and really engage with those deals. And if I like something, I want to be able to buy it, like shoes. And when I want to double down now that there's a bit of a correction. Yeah, it's not a bad time to start. How about that? Now is definitely not a bad time to start angel investing. Valuations have come down. Founder hustle has gone up. There's a lot of good stuff going on. So I sort of told myself that if I spent a little more now, it wouldn't be the end of the world. So I'm not perfect there. And I think what's this question here? What skills do I need to develop to better screen potential investments? I love hanging out with other people, like the group Katie's forming here. I have a group I like of female operator angels called the Council. And I don't know if they're screening better. I think the question two ways. Screening things are better. Screening for potential investments, I think there's, where you're going to get deal flow and see your deal flow. And is it a place that's getting a lot of deal flow? If it's getting a lot of deal flow, that deal flow is potentially better because things are moving faster. I really am as a founder, this is my founder point of view. People can disagree with this, but I really love angel groups that move quickly. The ones that move slow and take, stack you up for 6 weeks and take a quarter to evaluate and then decide to write a check. I hate to break it to you, sister. They are not getting the best quality deals because the best quality founders do not have time for that. So there is a correlation between how fast you move and the quality deal you get at a certain level. So I would go to a place that sees a high velocity of deals, even if that means you just join the group temporarily to see that high velocity of deals and see a lot of things go by. Because then what you're doing is developing your gut. What things about founders do you like? Ooh, what kind of businesses do you like? What does a good, well thought out pitch look like? Two of the biggest things I learned from Angel Squad, which is Hustle Fund's angel group, was this notion of earned insight. What is that unlock the founder has found that they're telling you when they pitch that you didn't know before and that they could only learn in the market? I learned that concept, and I learned the concept of market pull. When is there like momentum behind a product that people want it so much that somehow the founder and the founding team can't keep up with the demand? When you see a lot of deals, you start to feel companies that have those things to them. And that's just in the seeing a lot of deals. And I think your gut just develops from there. I don't know if that answered your question, but
do you mind if I add to that?
Chime in because you have a group. Like, this is perfect. I would love if you did.
Yeah. So I think to Cheryl's point, when you see a lot of deals and you do start to really understand what success does look like. To me, it's very important what the team looks like, and if the team is capable of doing what they intend on doing, while also being comfortable with pivoting. Cheryl was talking about earlier, if you're writing pre-seed and seed investments, which is where I am, then you have to expect the company that is being pitched to you is not going to be the company that exists 10 years when you have the exit. So while also keeping in mind, you have to, retain that relationship for about, 7 to 12 years. So is this someone you want to deal with for 7 to 10 years as well? So there's, there's a lot of human aspect to it as well, other than just, what do your numbers look like? Because there aren't going to be a lot of numbers at that early of a stage.
Yeah. I mean, I'll tell you, my last company, we grew in 2.5 years. We grew to 10 million in ARR. That is incredibly fast growth. And do you know what we wanted to do next? we wanted to pivot because we had fast growth, but it still felt like we were pushing a rock up the hill. And in pushing that rock up a hill, we found where we thought the bigger opportunity was. So I was ready to pivot a company after 5 years in and 10 million a year in revenue. So like when you say things change as you go, they change as you go. There's a bigger opportunity on the other side of that, for sure.
Yeah, absolutely. And I think this is a good time to pitch my company a little bit. If these are things
Please.
that you're interested in, this is something that I'm working on teaching within my community, how to vet investments, how to become an investor once you have this knowledge of what is my budget and what am I comfortable with. So that's a part of my goal. So feel free to check it out. My website will also be sent in the recap email. So yeah, happy to move on to the next question. We have one on evaluating terms from Erica. So how do you
you
evaluate
want to maybe?
Sorry, go ahead.
Yeah, maybe. Do you want to lead with asking this, answering this one, and I'll follow on?
Oh man. So I'm not as good at answering this question. A lot of the terms are evaluated by the partners I'm working with. I'm an advisor for a lot of these companies. So you know, and it also, I think it really depends on where you're investing, right? As a team of smaller investors, I work with emerging managers, primarily pre-seed and seed. So you have to understand that when you're investing, you're not going to be the biggest investor for very long, even, if you are. So you have to understand that you might not have some of the rights that, a bigger firm might have later on. So in terms of, those additional features of terms, then you have to kind of think about that. You're a small check to them. And so it's something to take into consideration.
You're going to get, early stage, you're going to get the terms someone else set, whether it's the emerging fund manager that invested first or the super angel writing the $100,000 check, or in some cases, sort of the founder themselves that are trying to comp towards market. So, and 99% of the time, you're going to be investing off of a safe note with a post-money cap. So really what you should think about, and I've heard an angel conversation on this of maybe you should try to negotiate for this or that or something else. If you are writing a big check, go have at it. Your $50,000, sure, the founder will entertain that. If you are writing a small check, $1,000, even $5,000, maybe even $10,000, the minute you become that angel, that's not fair. I don't want to sound grateful, but it's not fair on the founder. That is not what you want the founder to be doing, is negotiating pro rata rights with your $10,000 check, unless you are super strategic to their business. And then the founder will initiate that conversation. Otherwise, the real thing you're going to look at is valuation. Does it make sense for the market and where they're at? And this is why it's great to join a group like Katie's or another group that's seeing a lot of deals, because you'll get a gut feel for valuations. But like early stage, I usually have I like my early stage valuations between like 5 and 10 million post money, maybe 12 if they've got some good revenue. I get a little kinky on anything over that. Although I just wrote a $1,500 check into a company that's at the seed stage with a $20 million valuation. So there you go. I have to be able to look at the company and say, could I feasibly believe that this company exits for at least 25x the valuation I'm investing at? And on my little website, there's a little chart that shows you how that trickles down over time with dilution and other investments coming in. And you can sort of feel what your own number is being comfortable with. But a little bit of it's more of an art than a science. The data actually shows that valuation, even at early stages, is a pretty efficient market. So even something that seems like it's marked way high up early might not actually be that off base. So sort of learn by doing. And a group like Katie's to help you learn by doing. But I would say the only thing, unless you're writing a big fat check, the only thing to really look at is valuation. And do you feel good yourself about that valuation for that company and the stage they're at? it's, you can comp it to market with doing the 25x, but also think about what that means for the founder raising again. The company I just invested in at 20 post money came out of Y Combinator in 2021. So their pre-seed round with no traction was at 16 million post. Those girls could be out trying to raise now at 30 or 40 million, just because that's sort of the metrics for raising, but they knew their business didn't support that. So they made the smart move and said, we're still a little frothy in our valuation, but we're going to raise just a little bit higher than we did before, because that's more of a match to our business. And to me, that signaled really well about the founders, because they're not going to get themselves in a situation where they've overraised at too high of a valuation and then, have to do a down round and get some of the terms in there that do hurt us earlier investors, but that we can't control. Is that a fair answer, Katie?
Yeah, I think that's a great answer.
Maybe too geeky.
No, it's a great answer. And I think that in the same way that we as investors have to think about, do we want this relationship for 7 to 12 years? The founders are thinking the same thing. So as Cheryl pointed out, you don't want to be the person coming in with $5,000 saying, well, put me on your board, do this and that, that won't work out. They won't want you and you'll lose that deal.
And even if you got in the deal, is that what you want your founder to spend their time doing? That's a full-time job, figuring out how to maneuver and grow an early stage startup. You want them focused on that. My best investors, I have investors about to write checks for me for the third time around. They've been with me as angels in my other two companies. And my most valuable angels were sometimes the smallest checks I took in, because you know what those angels did that no one else would remember to do? They would just send me a really human note cheering me on when I sent them a monthly update. Like, they would like my posts, they would retweet my tweets, all those tiny acts of amplification and just human to human support that some days don't feel you get enough of as a founder. So you can be the most important investor on that cap table for $1,500 or $5,000. I have those people. And I'm definitely going back to them for this one because I want them there cheering me along. So
that's amazing. Thank you. So Lily asked again, so I think she was talking about the speed of the angel groups moving really fast. So she said that speed can be really scary. How do you suggest conquering that?
I think the speed I was talking about angel groups, like usually you have a few weeks to evaluate any deal and sit with it. You don't have to jump at any deals, right? Like, I sat and I watched for 6 months. I'm a founder. I know how startups work. And I sat and watched for about 6 months, maybe a little bit longer, before I jumped in on anything. Because I wanted to see enough stuff and get a sense for what I felt good about and not good enough, and understand my different emotions and logic behind different deals before I even wrote a check. And I was writing baby checks. I think my feeling was, now I have a group of maybe 4 deals I wish I had written checks into. Oh gosh, I wish I did that one. I think about those founders every day. And in retrospect, I realized I could have, because it was a $1,000 bet and it fit my budget. But that took me a while to learn. So you don't have to go with the speed with the market. You can see a lot of stuff and not pull a trigger. Most places will give you 2 to 4 weeks to pull that trigger. And I think as you get more experience with it, again, when I say you feel before you think, when you feel something, you feel it right away. And there's a reason for that. It's not empty emotions. There is a reason. And it's your read on people and problem spaces. I can guarantee that.
Yeah, and that's part of why I wanted my community to be both male and female, because the gut instinct of men and women are completely different and they complement each other so well. The conversations I have after a pitch meeting where their partners that are men that I was on, we have completely different things to say, but it's very helpful to have that different perspective.
Mm-hmm. It is. It totally is. And I've seen different deals that I have brought to mixed gender groups and single gender groups take completely different trajectories.
It's
Which is
interesting.
why I think more people have to get in the game, because those different sensitivities allow different problems to be solved and allow different kinds of founders to solve them.
Absolutely. Yeah, so Lily said 2 to 4 weeks is a great range to know about these investment decisions. I think, it truly depends on the team, right? If there is a team.
Mhm.
I suppose
Yep.
most of my investments have been with a team. So having the conversations around, what does that timeline look like when you're with a team, and then understanding,
Mhm.
are you going to make the decision in a week, 2 weeks? What does that look like? Or when you're on your own, you know, what are you comfortable with? And when you are
Yep.
on your own, you can have a goal for your timeline and still at the end of those 4 weeks say, this isn't I'm not ready for this yet. And then see where that takes you.
Yep. Yep. And you know what? If you miss something because you're busy or it's moving too fast, well, guess what? Something else will come along later. Like, this is not a zero-sum game. There's a lot of founders solving a lot of things out there.
Absolutely. It's a fun space to be in. You see a lot of new and exciting things.
I know. You can probably guess from how I think about things. I usually make a pretty fast decision if I love the founder and I love the space. And because I make a fast decision like that, I've used it to be able to like follow up with one or two people in the group who are also thinking about the deal just to get their perspective on it. So I can learn a little bit, learn a little juicy nugget to take along with me. I don't know, maybe once or twice it's changed my mind on the negative, maybe once or twice on the positive. Um, but it's how I've increased my sense of gut.
Yeah, and I think a kind of a trend that I've been seeing in this conversation is, listening and learning and kind of sitting back and waiting. And I had that experience myself. You don't learn how to invest overnight. It's a process. And
Mhm.
so just keeping your mind and your brain open to listening, recognizing you don't know what's going on necessarily. So what can you learn? How can
Mhm.
you better your process? That's
Yep.
key in investing.
Yep. But at the end of the day, maybe if you're writing small checks, sometimes the best learning is doing and
Yeah.
seeing what it feels like afterwards. Because I mean, for better or for worst, none of us are going to know how we've done as angels for 7 to 10 years.
Right.
I have no idea. I might be the best, smartest angel out there, or I might suck, and I'll call you. I'll call you in 7 years and let you know.
I love that. Yeah, I mean, and you have to write your first check sometime. So, it doesn't need to be the perfect one. Just
Yep.
do it and get it started.
Yep.
So,
And I'm going to add one more thing. Because I'm a founder and I have angels that are, I have a handful of angels that are about to write their third check into me. I have not made them money on my last two businesses. I would have to fight them away for them not to write that check because they're on a journey with a founder. They know one time I'm going to hit. All of us as founders will hit. It's not always the first time. It's usually not the first time. And part of what they're buying is that journey and the impact of what I will do when it does hit. And I don't think they would trade that for anything. So think about that with your checks too. There's a founder there that you believe in. And that founder is going to stick with it because once they do one startup, if it doesn't work, they can't get a job anywhere else. They have to do another one. That's what it is. It's the nature of the beast. So think about the kind of person you want to go on a ride with, and what amazing things they could accomplish because you are helping make that happen. And maybe we'll make you a fortune along the way while you just sit back and watch. And that would be great too. So
that's fantastic. Thank you
that's
so much,
that's my
Cheryl.
last parting thought as a founder.
I love it. I
Oh,
love
a
it.
founder today.
And I guess, we're out of time. I guess we have a couple minutes if anyone has any burning questions, but I do want to thank everyone for being here and for listening. And I want to thank Cheryl for her time. She's so graciously prepared this for us and shared all of her great knowledge, which I appreciate. And I welcome everyone to take a look at Play Money. Their website is letsplaymoney.io. And then my community is www.joinauxinlabs.com. So yeah, check us out and I'll send a follow-up email to everybody.
Join Auxin. Angels better with friends. I swear it is. I swear it is. You won't regret it.
Thank you, Cheryl. All right. Well, I hope everyone has a great rest of your Tuesday.
Bye now.
Bye.